The IRS recently announced some changes to inherited IRAs, so keep watching as I'll discuss what those changes are and some tax planning opportunities that have come about because of them. Welcome back. This is episode 200. I can't believe I'm already at episode 200. I want to thank everyone who continues to listen and watch the episodes on YouTube. Your comments, support, and questions inspire me to keep this podcast going. So thank you very much. I look forward to recording many episodes more. So in this week's episode, I'm addressing a recent update for anyone who inherited an IRA from a non-spouse who passed away on January 1st, 2020 or later. I talked about this 4 months ago in episode 180, but since then the IRS has come out with some additional information pertaining to this and how it might impact your taxes for 2024. So that's what I plan to discuss today. But planning for retirement is complicated, and I do my best each week to help give you tips and tricks on how to manage this. However, some of you need more help, and one way is to reach out to me directly for help. And you can find out more by going to retirewithryan.com and clicking on free assessment. I am taking on new clients, so you can check that out. Or if you're not yet ready for that, or you're more of a do-it-yourselfer, you can also go to retirewithryan.com and you can click on courses, and you can sign up to take my on-demand retirement readiness review course where I walk you through much of what you need to know to plan the ideal retirement. There's over 7 hours of information, as well as many helpful checklists, and you currently have lifetime access to the material. So check that out. So let's get into what's new with inherited IRAs. So I'll start by giving a quick recap of what I discussed in episode 180 to give you some context. If you have time, I suggest you go back and listen to this episode. So beneficiaries of pre-tax retirement accounts have always had to pay taxes on the accounts they inherit. However, on January 1st, 2020, the SECURE Act was passed, SECURE standing for Setting Every Community Up for Retirement Enhancement. And this bill changed the annual amount that beneficiaries of inherited IRAs that inherit IRAs after January 1, 2020 would have to withdraw from these accounts going forward. And this annual withdrawal is known as Required Minimum Distribution, or RMD for short. So prior to the SECURE Act going into effect, non-spousal beneficiaries had 3 options as far as how they could take money from these accounts. They could take the account out and cash it in as a lump sum and pay taxes on it. They could take the account out over the course of 5 years and pay taxes on it. Or they could begin taking distributions the year after the account owner passed away and then take out the beneficiaries based off their life expectancy or over their lifetime. This is sometimes was referred to as a stretch IRA. And obviously that option gave you the most tax flexibility because that would cause you to pay the least amount of taxes. And this is what I advise many of my clients to do. Well, unfortunately, the IRS realized that they needed more tax revenue, would be my guess. And that's why this change occurred with the SECURE Act. So starting with the SECURE Act, most non-spousal beneficiaries now must empty their inherited retirement account by the end of the 10th year following the original owner's death. However, there are a few exceptions to this 10-year rule for certain types of beneficiaries. These exceptions are persons who are disabled that inherit a retirement account, persons who are chronically ill who inherit a retirement account, persons who are not more than 10 years younger than the original owner or decedent who inherit a retirement account. So who would that be? Probably if you inherit a retirement account from your friend, from your brother or sibling, somebody non-spouse within 10 years or age, and then minor children also have the ability to take distributions out over their life expectancy until they reach the age of majority. So all these beneficiaries have the option to take out these lifetime distributions. Think stretch IRA, as it used to be called before. These are also sometimes referred to as eligible beneficiaries. However, non-eligible beneficiaries would be anybody that didn't fall into those other 5 categories, who inherit traditional IRAs and other retirement accounts, and Roth IRAs or Roth 401ks for that matter, after January 1, 2020, now have just 2 distribution options. I mentioned earlier. One is the 10-year distribution option. And that would mean by the end of the original owner's death, 10 years later, the account has to be completely emptied out. The other option is that you can take the account out in the same year the person passes away, and you can completely empty the account. So let's just say you're choosing the 10-year option and your father passed away in 2021, leaving you his retirement account. Then following with the next year in 2022, you would need to start, the 10-year window would start for that withdrawal period, that 10-year period, and then by the end of that 10th year, the account would need to be completely emptied out. So this is where you are impacted by inheriting an IRA if you're in this situation and where this IRS publication, this announcement pertains to you. So when the Secure Act came out, everyone thought that all non-eligible designated beneficiaries who opted for the 10-year window to withdraw all the funds could choose how to withdraw the funds over the 10-year period, meaning as long as the account was completely emptied out by the end of the 10th year, there'd be no penalties for that beneficiary. This would give people who inherited an IRA from a non-spouse multiple options. They could potentially minimize distributions in years where their income was higher and take higher distributions when their income was lower. So you could pick and choose how you paid the taxes on this account. So let's just say, for example, again, you inherited your father's IRA and you're still working. You're going to be retiring in 3 years. Maybe the first 3 years, you then don't take any money out of that account, because if you did take that money and because it's taxable, it got added to your other taxable income, it might push you into a higher tax bracket. So you were believed to have that flexibility. That was the original interpretation that everyone thought applied. However, in February of 2022, about 2 years ago, the IRS issued its proposed regulations to reflect changes made to the Secure Act. That's how long the IRS takes to issue something. 2 years later, after the Congress passes something. And what was a surprise to many, its proposed regulations called for another bifurcation of beneficiaries. Specifically, it would divide non-eligible beneficiaries into two groups. And that would be people who inherited an account from somebody who passed away before they reached their required minimum distribution age, and somebody who passed away after. So in other words, if for those who died before reaching their required minimum distribution age, you would have one option, and if you died after, you'd have another. So the required minimum distribution age was originally 70 and a half. In 2020, that got changed to 72. In 2023, another Secure Act 2.0 was passed, and now it's been increased to 73. I might have misspoke there. It went from 70 and a half to 72. Now it's 73. And then starting in year 2033, it's going to 75. So those inheriting IRAs from people who died before the required minimum distribution age could wait until the 10th year to begin taking distributions. However, those inheriting IRAs and retirement accounts from people who died after the age of required minimum distribution, depending on what year they died, right? From 70 and a half to 73, would have to take distributions out every year to continue the distributions of the original owner. So that is what really threw people for a loop. Nobody thought that you had to take any money out of these accounts until the 10th year. So this created a lot of confusion, and the IRS realized this, and they had a public comment period where you could submit comments, and a lot of people submitted comments that obviously this was very confusing. They had not, realized this. They had not taken their distributions, because this didn't come out until 2022. So there's potentially a couple of years that people missed taking distributions. So the IRS extended some relief and said, if you were supposed to take RMDs from an inherited account in the year 2021 or 2022, those are being waived. Then in July of 2023, they extended that relief for 2023. So you didn't then have to take these distributions out for 2020, 2021, 2022, 2023. So they were pushing the proverbial, tax trap down the road even further. Now, along the way, I should note that the IRS also changed the penalty for missing IRA distributions. Originally, it was 50%, pretty hefty, right? Who would want to pay a 50% penalty on money they thought they were supposed to take out? Well, they reduced it to 25%, which was nice. And then they also changed it so that if you missed a year that you thought you were supposed to take it, or you were supposed to, but you didn't know, they would, as long as you made up that distribution within 2 years, they reduced the penalty down to 10%. So they're trying to be helpful with this massive confusion that I guess Congress created. So just a few weeks ago, the IRS came out with Notice 2024-35, which announced that the required minimum distribution for 2024 was being waived for certain beneficiaries. So again, this means if you inherited an IRA for someone who passed away after January 1st, 2020, you don't need to take out distributions from that account for 2024 either. Now, in my previous episode, if you go back and listen to episode 180, or if you have phenomenal memory, you'll remember that I said some tax professionals who I talked to were not quite sure if you should not take your distribution out for 2023 because the IRS still wasn't being clear. So they recommended maybe doing that. So that, however, I think is a little more clear. So meaning that the IRS has pretty clearly said that you don't need to take out a distribution in 2024 if you don't want to, if you inherited an IRA for somebody who passed away 2020 or later. But you can still play it safe and you can take it out if you want. So now, what was once a confusing law is even more confusing. So what should you do with this information? Well, you need to do some tax planning or some tax projections about what your future income is going to be if you've inherited a retirement account from somebody and you're going to need to take it out within the next 10 years. For example, if you're going to be in a lower tax bracket this year, but you anticipate being in a higher tax bracket in the future, like meaning that this year maybe you retired, but you're not yet collecting Social Security or not yet collecting a pension, or you find that your income is lower this year because you're in between jobs or you're laid off, this could be a great year to take a distribution. If you think that, by doing these projections, as far as you knowing that you're going to have to empty out this account over 10 years and you're going to need to take that money out and pay tax on it, you're going to be in a higher tax bracket in the future. So that's one thing to think about. Let's say you're in a higher tax bracket this year because you're going to be retiring in the next couple years, then maybe you don't want to take this distribution this year. So keeping in mind that if you inherited an IRA in 2020, you have 7 years left to empty the account. So have you projected what it would look like if you had to empty this account out over the next 7 years? And what would that additional income do to your taxes? If you add that to other income, employment income, Social Security, pensions, any other income that's taxable, where would you be on the tax bracket scale? So if you find that you're going to be in a higher tax bracket, then maybe there's some other things you can do. But the point is that you need to be doing this planning. I find that a lot of people, some people don't even know about this. I've had people reach out to me that didn't even know they were supposed to take out money from their inherited IRAs. Their advisor never even told them. So you need to understand what your potential tax liability is so that you can plan to potentially minimize it. Maybe you can't, but maybe you can. So what about if you inherited a Roth IRA? I mentioned earlier that Roth IRAs and Roth 401ks are also subject to the 10-year rule if you're a non-designated beneficiary. However, these accounts have been taxed, which means no tax is usually due when withdrawing funds, and except if the IRA owner died before the end of two things occurring. One, the 5-year period beginning with the first tax year for which a contribution was made to a Roth IRA. So if somebody just set up a Roth IRA and it's not more than 5 years old, there could be taxes due. And or if somebody made a Roth IRA conversion or a Roth IRA rollover, then that also has a 5-year holding period. So provided that the owner of the account that it left you the Roth IRA got through that period, you then have a 10-year window to completely distribute the inherited IRA or the inherited 401k. So should you take a distribution from your IRA or a Roth IRA or Roth 401k before the end of the 10-year window? Well, as usual, that depends. Let's just say, for example, you're working and you're trying to save for your own retirement. And this could apply too if you're married and factor in your spouse's contributions as well. And let's say that you are not contributing the maximum to your 401k, or you're not making Roth IRA contributions. Well, why not take money out of your inherited Roth IRA and use it to fund your Roth IRA or Roth 401k or 401k? Because eventually this money has to come out at the end of the 10-year window. Why not reposition the money that is already tax-free into another account that's potentially tax-free or gives you a tax deduction? Those are things that you could be doing to reposition the money. And it also could create multi-generational wealth, because now whatever you put into your Roth 401k or Roth IRA, that can sit in there your entire lifetime, and that could allow this money to grow to even more. Let's say you're already maximizing your retirement account contributions for work and you can't put any more in, or you already have earned income. Well, in those situations, it might make sense for you to just leave your inherited Roth IRA alone or Roth 401k until you need the money, or let it grow for the 10 years and let it get as much compound interest growth as it can, and then at the end, just take it out. Again, it's not going to be taxable, but it can mean more money coming to you tax-free. So the more time you can give that to grow, probably the more it's going to grow to, and the more you're going to be able to get tax-free. Taxes in retirement accounts, unfortunately, have a lot of complexity. And I hope this gave you some information on how it works, but you can see it's complex. If you're not working with a certified financial planner or a CPA or a team, of both, and you have an inherited IRA, now might be a good time to reach out to one and get some help, because you don't want to miss out on planning opportunities that may exist for you. Again, a lot of people are uninformed about these accounts, and there's definitely opportunity for you to strategize about how to make the most of them. So as always, if you have a listener question and you want to have it considered for a future episode, head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking with you next Wednesday. Take care.